The Psychology of George Soros, How to Manage Risk Like a Pro. Welcome to today's video, where we uncover the psychology behind one of the most famous traders of all time, George Soros. Known for breaking the Bank of England, Soros' approach to trading and managing risk is an essential lesson for all traders. Let's break down how Soros not only mastered the markets, but also the mindset required to take calculated risks. Who is George Soros? George Soros is best known for his $1 billion profit by shorting the British pound in 1992. This move earned him the title of the man who broke the Bank of England. But Soros is not just a trader with deep pockets. He is a master of understanding financial markets and human psychology. In fact, his trading strategy is rooted in his belief that the market is driven by human perceptions and not just economic fundamentals. The psychology of risk management. Soros is a firm believer in the importance of managing risk. In his own words, it's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong. Soros is willing to take large risks, but only when the reward outweighs the potential loss. This mindset is crucial in trading psychology, where emotional impulses often lead to reckless decisions. Lesson 1. Control your emotions and stick to your plan. The key to Soros' success lies in his emotional discipline. He has the ability to control his emotions during periods of market volatility. When most traders panic, Soros remains calm, executing his strategy based on thorough analysis. If you want to be successful, avoid chasing short-term wins and focus on executing your plan despite market noise. Lesson 2. Be willing to cut losses quickly. Soros once said, "I'm only rich because I know when I'm wrong." This is a crucial aspect of his psychological approach to trading. Soros is quick to cut his losses, a lesson that many traders fail to adopt. Emotional attachment to a trade can cause you to hold on to losing positions, hoping for a reversal. However, successful traders know when to admit they're wrong and move on to the next opportunity. Conclusion. George Soros' psychological mastery of risk management and his emotional discipline have made him a legend in the trading world. The lesson here? Embrace risk, but manage it wisely. Cut losses early and stick to your strategy. Trading is as much about psychology as it is about the markets. Remember, your mindset can be your greatest asset or your biggest liability. The Psychology of Jesse Livermore, Overcoming the Fear of Losses. In this section of the video, we'll look at the life and trading psychology of Jesse Livermore, known as the Boy Plunger. Livermore made and lost millions in his lifetime. His story is not just about making the right trades, it's about overcoming emotional barriers and fears that could have otherwise destroyed his career. Let's dive into how Livermore overcame his psychological struggles to become a legendary trader. Early life of Jesse Livermore. Jesse Livermore's story is one of highs and lows. He was born in 1877 and started trading at the age of 14. His initial success was driven by his ability to read the market, but it wasn't long before he experienced significant losses. Despite his setbacks, Livermore continued to refine his strategy, and he eventually became one of the most successful traders in history. The fear of losses. One of Livermore's greatest challenges was dealing with the fear of loss. In his early years, he would often close out positions too early, fearing that the market would go against him. Over time, he realized that this fear was not rational. It was his emotions sabotaging his decision-making. To overcome this, Livermore developed the habit of sticking to his trading rules and ignoring the noise around him. Trading with confidence and patience. Livermore was known for his patience. He understood that the market moves in waves and that every opportunity isn't a perfect one. Successful traders don't rush into every trade. They wait for the right moment. In Livermore's case, it was his ability to wait for the market to confirm his analysis that made him successful. Lesson 2. Handling emotional roller coasters. Livermore's career was an emotional roller coaster. He experienced extreme highs of success and deep lows of failure. The key takeaway? Livermore taught us that managing the emotional highs and lows is just as important as understanding market trends. He advocated for a calm and detached mindset, which allowed him to continue trading without letting his emotions control him. Conclusion. Jesse Livermore's legacy teaches us that trading psychology is everything. Overcoming the fear of losses, maintaining patience, and staying emotionally disciplined in the face of uncertainty are all vital traits that successful traders must develop. If you can master your emotions, you can master the markets. The psychology of Warren Buffett, building patience for long-term wealth. Today, we're exploring the trading psychology of Warren Buffett, one of the world's wealthiest and most respected investors. Buffett is known for his long-term investment philosophy, which is rooted in patience, discipline, and an unwavering commitment to his strategy. But how did he develop this mindset? Let's break down the psychology behind Buffett's approach to building wealth over time. The Buffett approach to long-term investing. Warren Buffett's investment strategy revolves around the concept of long-term value. He famously says, "Our favorite holding period is forever." Instead of focusing on short-term market fluctuations, Buffett looks for companies with strong fundamentals and a clear path to sustainable growth. But the real question is, how has Buffett developed the patience to hold on to investments for decades? Lesson 1. Patience is the key to success. Buffett's greatest psychological strength is his patience. In a world of rapid trades and instant gratification, Buffett remains calm and allows his investments to grow over time. He's not swayed by daily market movements, and he doesn't get caught up in market hysteria. By remaining patient, Buffett can take advantage of the compounding effect that grows his wealth year after year. Lesson 2. Confidence in your strategy. Another lesson from Buffett is the importance of confidence in your strategy. Buffett's approach is based on thorough research and understanding of the businesses he invests in. This allows him to remain confident in his investments, even during times of market turmoil. For you, the takeaway is simple. Do your research, trust your strategy, and don't let market noise cloud your judgment. Emotional control in times of uncertainty. Buffett's emotional control is legendary. While other investors panic during recessions or bear markets, Buffett uses these times to make smart investments. His ability to separate emotions from decision-making allows him to buy undervalued assets when fear dominates the market.